Jim, I am sick and tired of reading the media about, everybody says 2007 is like X.
Yeah, I remember that in 1997. I did endure that too. It really is painful.
Well, so what I want to do is I want to do a lightning round of years.
Sure.
So I'm going to ask you the year, and you tell me if it's how it might be like or not like 2007. So let's do 1987 first.
Okay, 87 was a year where the market had had an unbelievable move intra-year. You know, we tend to think that an 8-10% year is a good year. I mean, this, we're talking about, the market was almost doubling. It was almost doubling in a couple of years.
Sure.
And I think what people have to recognize is that you could basically come in every day and expect the market to rally 1 to 2% every day. So we were due. We just weren't due for what I thought was that big a pullback.
So what's the difference? And let me point out some similarities. You had kind of a larger rate cut than usual the month before, the September 1987, before the crash. You had a weakening dollar where everyone got a little nervous about. You had financial institutions, some panic on the savings and loan side. You had a Congress debating the tax benefits of private equity. So how are we different?
Like, give us some hope. It was 29 times earnings and pre-buyback. There were almost no buybacks. That wasn't a method. There was no stabilization. We had a product that guaranteed, we were still very in infancy of futures. We didn't realize the power of futures, even though they've been around for 3 years. So we had companies that were offering an insurance plan. You drop 5% and it will stop you out. And that product had no credibility. It had never been tested. It broke down entirely. There were no buyers underneath. And we moved from 20 times earnings to 29 times earnings in about 3 months. So, I mean, the multiple expansion was out of control at a time when we should have had multiple contraction.
Well, let me ask you about the portfolio insurance, because a lot of people say that's the difference between 87 and now, is that we're not as concerned about that. But derivatives have played the role of insurance not only across equities, but across every asset class. And so could there be the case that there's too much insurance and not enough of the other side of the trade once things start to fall?
Yeah,
which we almost saw with Northern Rock and Countrywide.
And, in the month of August, we had 3 days where everything went wrong. And it was 3 days where we could have dropped 2,000 points very easily, given how poorly the derivatives worked. But what happened is that companies came in and started buying back. Like you said in your Financial Times piece today, individuals came in and started buying back. And that's what happens when you have a market with a low multiple in an environment where interest rates are going lower. It just, you got to look at these things as long-dated assets, and they just come up as too cheap versus all the other asset classes.
1987, what were your favorite stocks the day after the crash?
It's interesting. The day after the crash, I went for J&J, I went for Merck. I should have gone for General Motors. I went for Phillips Dodge. I went for Alcan. These were companies that were just like killed.
Tech? Apple Computer?
No, because you couldn't get the NASDAQ guys on the phone to buy, even a couple days after, so you couldn't tell. Like, I wanted to buy Microsoft, but I couldn't get anyone to sell me any because I couldn't get a broker on the phone. I wanted to buy Intel. Intel had great confidence, but there was no one picking up. Buy Intel.
Fascinating.
Yeah, so you really couldn't.
Where were the brokers? They
well, they were afraid.
Suicide,
they didn't know what their positions were. They were they didn't want to trade. They were afraid that to be short, afraid to be long. So they just didn't answer the phone.
I was long Mesa Petroleum that day, but it didn't work out for me.
I don't think people recognize how fragile the system is. I did a piece with in Fortune magazine. Someone interviewed me, Corey Hajem, who's very good. And I just said, look, we always take for granted that prices are prices. But the stock market acted very much like the CDO market did this summer, which is that, well, who knows where they are? I don't know where the prices are. Your screen's wrong. You were constantly being told, like I tried to buy Caterpillar, and the market would say 48.50. But people would tell me that the screen was wrong on the offer side and the screen was wrong on the bid side. It was really 40.60. So, I mean, like wherever you bought, you'd be down immediately. So it wasn't as easy to buy as it would look like in retrospect.
All right, well, Jim Cramer on 1987. Thanks.